Hi everyone, welcome back. Today I'm going to be showing how to find the intrinsic value of a company using the discounted cash flow valuation and the unlevered discount cash flow valuation. Um, Using the discount cash flow valuation, the intrinsic value of a company is calculated by discounting the projected future cash flows and terminal value back to the present value using the discount rate. So that's what we're going to do to find the intrinsic value. Before we begin, if you like the spreadsheet, you can just go to my Patreon page. The link will be down below. You can just download it there. You'll have full access to it, to all the content. And if you like the content on YouTube, you can just hit the like button and subscribe. It would be much appreciated. So let's begin. We're going to use Pfizer as the example. As you can see, most of all the data in blue just automatically fills in. We only need to fill in the data in green to find the intrinsic value. Everything in blue is automatic. So all we have to do here is find the 10-year risk-free rate, which is the bonds, and all we have to do is go on the link, and we have the 10-year right here, 452. Okay, so we plug in 452. Okay, and you could see that the WACC changed, the discount rate. Okay, so now what we have to do is find the past free cash flow of the last 10 years of the company. So we have another link right here, which is Bar Chart, my favorite site. It's a really good site. And what we have to do is just plug in the stock ticker symbol. Okay, and I really like this site. One reason is because they have some data that other sites don't have. For example, like the put call ratio, as you can see, is at 0.67, which means they're buying more calls than puts, so that's bullish. Okay, so back to the subject, we need to find the free cash flow, so we come to cash flow. And we want to go 10 years back. Okay, and just come all the way down, free cash flow right here, and we want to plug in all this data, so that's what we're going to do right now. 16,478, 16,478, and just fill it all in. 15,885, 885, 13,291, 13,291. 14,369, 369, and 14,846, 46, 46. Okay, so now we want to go back to get all the rest of the years. 2018, here we go. All right, 13,843. 10,542, 10,542, 12,177, 29,869, 69, and the last one, 26, 31. Okay, so once we plug this in, the growth rate just automatically fills in right here, and we can see in the last 10 years, Pfizer had a 12% growth, which is good because it's a slow growth company, pharmaceutical companies. So what this does is it gives us the growth rate of the company in the last 10 years, but since it's a big growth and we want to find out exactly what the price would be in less than 10 years, I like to use the S&P 500 30-year growth rate to average it down, and it gives us a 10%. Still a little high, but that's okay. So once we have all this data, what happens is the future free cash flow gets calculated using the latest year and using the average growth rate, we get 28 for the first year, and then it just automatically does it for the next 10 years until we get a terminal value. And then it comes back to the present value, okay, and it gives us a 62%. So once we get all this data, everything just sums up and we get a sum of future cash flow right here. So now all we have to do is get these two datas, and we'll get everything else automatic until we get the intrinsic value. So what we have to do now is find the cash and cash equivalents, and we have another link right here. And all we have to do is plug in Pfizer and go to financials, balance sheet, and just go right here, total assets, current assets, cash and cash. And we want to use this one right here, 416, 416. And now the total debt is down here, total debt 34,870. 34,870. Okay, and we come to an intrinsic value of 5109. So it's currently above the current price, so that's good. And I don't know if you noticed, but this chart changed a little. What this is just charts from, this is the discounted cash flow growth, just grabbing all this data. I put up the chart so we could get a better look to see if it was going up or not. And as you can see, the trend is up. And this one is just to see if it's stable. Okay, as you can see, year after year, it's going lower until COVID, okay, but it's still stable. Some companies, they're just all over the place, and I don't like to see that. That's why I put up these charts. It's a little easier to see. Okay, so now that we got the intrinsic value of the discounted free cash flow, I'm going to do unlevered. And to find the unlevered free cash flow valuation, well, it is a method used to determine the intrinsic value of the business or asset by focusing on its core operational cash flow, without considering the impact of debt and financing. The key steps to the valuation, it's basically just this data right here, but all we have to find is these two because the rest is automated. I made it automatic so we don't have to look for so much data. So what we're going to do is just find the enterprise value. I already have the site over here, so I don't have to click on it. And this will be on statistics. And the enterprise value right here, it's 196.60. It's in billions, so we need to add a zero. So 196. 16, and we add a zero, okay? And now to find the net debt, which is back in financials, and it's in balance sheet, net debt 34,454. 454, okay? And once we plug it in, the rest just automatically does it. As you can see, the intrinsic value of the unlevered discount cash flow, it's at 28. So let me take this out because we didn't do these valuations. We only did two, so I'm only going to use these two to find the intrinsic value. Okay, so now you have two different prices, okay? And that's why you need to do a lot more valuations to get a more accurate price. As you can see, our intrinsic value is at 39.69. So it's still a good price to buy in right now. And as you can see, once we have the intrinsic value, everything automatically gets calculated, and we can see that the difference is negative 22, the difference, and the margin of safety at 20. I like to leave it at 20. You can put more if you want. And so our acceptable price is at 31.71. So that means we are at a buying price. Okay, and I did put a lot of ranges over here. If you want a 30% margin of safety, it would be at 27. If you want a 40% margin of safety, it would be at 23, and a 50% would be at 19. These are your target prices if you want to go by these percentages. I like to go by the 20, so to me it's at a good price to buy. That's why I actually put it on my portfolio data. As you can see right here, Pfizer. I didn't buy all the stake. I'm going to be showing right now what I did. So this is what I do, because I don't know if it's going to go down or not. I know this is the intrinsic value in the short term. It could go a little lower. So what I like to do is dollar cost average. So 40% I put on my first target. If it hits my second target of one of these that I choose, I will put 35%, okay? And if it goes even lower, I'll put the rest, which would be my dollar cost average of $1,000. And as you can see, I put my averages right here. These are my averages that I put in for Pfizer, and this is what I'm doing. Okay, this is my method of doing. You can just change this up and do it your own way. So that's how you find the intrinsic value of two companies. I will be showing how to find the intrinsic value of the other valuations next time. And I hope you liked it, and thank you.